Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments. I'm recording this month's edition of the U.S. Equity Market Chart Book on Monday, the 11th of February, just before, or a little bit before market close. And we go through this regular chart set. I give you my in-between the line readings in blue, Nick's take on things. You can download the chart book at merkinvestments.com/research. And this first one here is just a long-term relative value indicator. The predictive power of this may be limited, but what it shows that in a historic context, equities compared to bonds are highly valued. Doesn't really say what is going to happen going forward, except that if history is any guide, the returns going forward may be very meager, very limited, and this particular predictor suggests that the returns are near zero over the next 10 years. Not in a straight line, also not claiming that there's an accuracy, but what it does mean is that if somebody is uncomfortable with the valuations we have right now, then there is historic precedent for that. This is without dividends reinvested, for what that may be worth. But obviously, we have many signs here of late phases of a bull market, late phases of an economy. And if you go according to their theory, you want to be invested during economic expansion and out of the market during recessions. Well, where are we, right? And so this gives a little bit of flavor on that. And the one thing I'd be reluctant to do is to say, hey, today is the peak of the economic cycle and tomorrow is going to be a recession. Therefore, you're going to be out on date X. As you may be well aware if you have listened and watched the markets in recent weeks, this is not a thing where somebody turns a switch and you will know exactly where we are. Indeed, there's lots of theories as to why we're in a slowdown or a soft patch or this or that. Clearly, the markets have signaled that late last year that they wanted the Fed to take a break because glasses are half empty suddenly, and then earlier this year, suddenly everything was dandy again, right? And so we'll go through these charts to give you a little bit of a context here of where we are. And earnings backdrop, we've seen some softening in earnings, but hey, it's still positive, right? And so same in business cycle, the leading economic indicators dipped down, they recovered, but not back where they were. So all these are kind of near the top cycles. The one thing that really gets people concerned is that the purchasing manager indices have been coming down. You see here that China is under 50, that Germany dipped under 50, that Japan is close to 50. And of course, there are many people that say, hey, you cannot have this precise line of above and below. This is not a guarantee that we'll be in a recession if it's below 50 and so forth. But sure, several of them had dipped down. And obviously, if you look at the US PMI, that's the red line, that also dived down. And of course, that has recovered a little bit. And there will be economic number distortions with the shutdown we had in January. The question is still, does it translate to a recession in the US, that we have a global slowdown? And you could, of course, argue, hey, China is the big elephant in the room and does things. What the Draghi and the European Central Bank says, and I sympathize with that maybe the most, is many of the threats that are out there, there's a way through this, right? Take trade tensions. Most people believe some solution will be found, maybe not by the end of February. Who knows what's going to happen there precisely, but if everybody works in a good effort way, things could move forward, but it could take a little longer. Same with Brexit, right? They seem to be good at kicking the can down the road, not at finding solutions. And yes, that holds back investments, but people don't expect a hard Brexit at this stage because they think that people will just postpone making the decision. Same with many other issues. Now, all that said, it has started to affect confidence. And when it starts affecting confidence, then people make fewer investments. And so, yes, it is possible to get a slowdown. Some people say that President Trump has put the cycle back into the business cycle with his activities. And that may well be the case. But of course, you don't know whether this is just a quote unquote soft patch or whether that will continue. I'll give you my own take here in a minute. Financial conditions. When the index here is the Chicago Fed Financial Conditions Index, when, as in 2008, this dives all the way here down on the chart. It's then it's an inverted chart, so that's why I'm just hesitating how I phrase this. financial conditions continue to be easy. Now, mind you, it depends a great deal what you use as a reference for financial conditions. We happen to like this index. We thought that the Fed was looking at this index. I said we thought, because clearly Mr. Powell has been more sensitive to the stock market of late, at least when the tantrum happened in the markets late last year. And so there are several other financial condition indices that are pretty much reflections of the stock market. So if that's one you want to take, well, then look at the VIX index, and then you got your financial conditions. But ultimately, this is what should matter in the sense that it is more, the economy is more than the stock market. It is about having access to credit. And yes, on the fringes of the economy and emerging markets and so forth, there are trouble, but those trouble have not made it to mainstream. Now, on the technical side, there's an argument to be made that things don't look so bad. The advanced decline line, for those who watch those sort of things, is doing just fine. That is not an indication of a deteriorating market. This is a very short-term horizon here, but historically in bear markets, before reaching the peak, those fundamentals here in the had really deteriorated, and that's not the case here. So that's an indication that we may not be at the end of it. This is the market sentiment based on the American Association of Individual Investors. It's kind of a little bit above average. So, and that means that maybe one should be a tad concerned, but this is just a normal mid-level range. Margin debt, depends on how you look at this, but this year as a ratio of the S&P doesn't look like extremes. In absolute terms, which we don't show here, it does, of course, reach new highs periodically as the value of total stocks outstanding is higher. And so it's a bit controversial of which one to look at, but we think that from a historic point of view, this is something to watch in this ratio framework, and there's nothing extreme here to be seen. We've shown this chart before. I'm not going to go here into the details. Please download the PDF to read this in detail. But the previous chart is an explanation. There's the implication. What you want is if you want the market to go up, you want there to be a little bit of panic in the market, so to speak, which means that you want to have things move in tandem. You want volatility to be high. And so we had kind of moved into that environment. Of course, we were kind of a bit of the way up because we had this spike that we had late last year. The question again is this the beginning of something, or are we through this already? And of course, that's very difficult to extrapolate. Economic uncertainty has increased of late a little bit, so you can climb a wall of worry. The VIX curve, early last year, everybody learned about it. Basically, there is no quote-unquote backwardation. Things are priced normally in the VIX curve. I'm not going to go too that much into detail. Of concern is that we continue to be below the 200-day moving average in the S&P. And by the way, even if you're not a technician, a reason why that's relevant is because so many people are market technicians in the markets. And this is a reminder that returns in the markets are volatile and rarely ever as expected. Last year, the market was down. And year to date, it is up. Surprise, surprise. So here is the overview of all that. And here Nick's assessment based on these different indicators is that neutral to positive with high uncertainty in the short term, and neutral to negative with high uncertainty in the medium to longer term. So what do we make of all this? Again, we're in the late stages of this economic expansion. This is not about the Fed per se, and please look at the chart book for that, but somebody pointed out this morning as I speak on Bloomberg Radio that the Fed has become a bit asymmetric right now, meaning if data come in better than expected, they're still in pause mode. And if they come in worse than expected, they might lower rates. In any case, since they're quote-unquote pausing, odds are that they're not going to change interest rates, or at least not hike interest rates for at least 3 months, possibly for 6 months. And then we're right there where I thought that we would be, meaning that we still have an opportunity for 1 or 2 rate hikes. Now, as I speak that, some people in the market are saying we're going to have a rate cut. Clearly, if the weakness we see from the rest of the world comes to the US, that is a possibility. But also keep in mind, the Fed does not really have the foot on the breaks. They are just at the lower end what they consider to be providing additional stimulus. And not shown here is that I happen to believe economic pressures are, inflationary pressures are building, mostly due to rising wages. And while, of course, that's good on the one hand that workers have more money at their disposal, we do see anecdotal evidence of price hikes in various industries. They don't show up at this stage as something of degree of concern. Later this year, we'll have year-over-year comparison on the oil market. And as that happens, I think the headline inflation numbers will go higher. We'll then also have higher core inflation numbers, meaning that these wage pressures will work their way through. So we'll have lots of ingredients in place why the Fed may continue to hike rates. And so with the accommodation we have right now, the markets may do just fine for a little while longer. And then the Fed will resume the hiking maybe, and then maybe the Fed will ultimately kill off this economic expansion as they do that. So now there are lots of ifs and maybes here. The short of it is we're not in a recession yet. That's our take on that, on my take. And I think the US economy will continue to trot along. Inflationary pressures will continue to build. And then as the Fed will get more comfortable with the rate hike, then we may see higher rates later this year. I don't think real rates are necessarily going to go up because inflationary pressures will have risen, at least not go up significantly. But what it all means is that volatility may continue to be in the market, may increase again as the prospect of a rate hike might come back into the market. And so kind of moving to a more defensive level as this economy ages, as this bull market ages, I think is all right. It's depending on anybody's comfort level. I, for myself, would rather be diversified than not, and not go all in, and then only when I think that the recession is about to start, go out, because I know very well that any of this is a nice crystal ball, but I could be wrong. And so anyway, that's it for today. There's also a premium chart book, on PDF chart book that Nick prepared. Please look at that. Since this video is behind a paywall, you do have access to the premium chart book as well. It has several additional charts that are well worth your time to dig into. And then otherwise, please spread the word to join us, and thanks for supporting our work. Have a good one. Bye-bye.